Welcome back to Investing Talk Podcast.
Today we're looking at Uber Technologies. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We have a wealth of recent information, especially with those huge Q3 2025 earnings that dropped earlier this month.
Oh, just right.
Yeah, and the main headline isn't just that Uber's growing revenue. Kind of expect that from them, right? It's that they've really shifted gears. It's not just about growth anymore. It's about profitable scale.
And they didn't just meet the expectations. They completely blew the doors off the earnings consensus, didn't they? But okay, beyond the headlines, let's look at the mechanics. What numbers really show that operational shift? Because that's what changes the whole investment story.
Well, the big one, the real knockout, was the earnings per share, the EPS. They reported $1.20. The analysts were expecting, I think, around 69 cents. So that's a, 74% beat, just massive.
Right.
Now, revenue growth was solid, too, up 19% year over year to almost $13.5 billion, also ahead of what people thought. But the real story, like you said, is the margin expansion.
That's the critical piece, yeah. We've watched Uber for years just pour money into growth, often, with negative margins. Now suddenly positive net income is becoming the standard. What actually changed under the hood to allow that?
It really comes down to classic operational leverage. Their adjusted EBITDA, it grew 33% year on year to $2.3 billion.
Okay.
And that pushed margins up to 4.5% of gross bookings. That's a really key metric for these big platform businesses.
Yeah.
It strips out things like depreciation, stock comp, and shows you how healthy the core service model is.
Right.
The mechanism is pretty simple, actually. Uber's tech, backbone, the app, the mapping, payments, it's a huge fixed cost.
Yeah.
So when gross bookings jumped 21% like they did, hitting nearly $50 billion up.
49.7 billion, yeah.
Right. Every new trip just costs less to service on that platform. And that leads straight to that big 33% growth in EBITDA. They're just spreading those fixed costs over a much, much larger base now.
Okay. Let's unpack that scaling a bit more. The money machine's clearly working, but how are they keeping that top-line growth going so aggressively? I mean, they're not exactly a small startup anymore. They're kind of everywhere already.
Well, the growth now, it's really coming from deepening the network effect, not just, adding new cities.
Yeah.
Yes, gross bookings grew 21%. That's huge.
It is.
But look at the usage numbers. They did 3.5 billion trips in the quarter. That's up 22% year on year.
3.5 billion trips. That's, what, over 38 million trips every single day?
Yeah, the scale is just mind-boggling. It's more logistics movements than some entire countries handle, probably.
No kidding.
And the consumer base is strong, too. Monthly active platform consumers, the MAPCs, they grew 17%. But here's the really interesting bit, the thing that drives the moat. Users are actually using the platform more frequently. Trips per consumer rose 4%.
Oh.
So they aren't just adding new people. They're getting their existing users hooked deeper into the ecosystem. Mobility, delivery, even freight.
Why is getting someone to take, one extra trip a month more important than adding 5 completely new users?
Because it turbocharges that network effect. If you use the same app for your ride, your dinner, maybe rent a scooter, it makes the whole system more efficient for drivers.
Right. Better utilization for them.
Exactly. Which means drivers stick around longer, response times get better, and that makes the service better for all consumers. It's that virtuous cycle. The platform gets stickier and stickier, making it incredibly tough for anyone else to break in, even if they have tons of cash.
That's structural advantage. That's the long-term staying power, isn't it?
Yeah.
And speaking of long-term, let's look further out. If solid execution is driving things now, what's the fuel for, say, the next 5 years? Because this is where it gets really interesting, beyond just ride-hailing.
You mean the big bets on autonomy and AI?
Exactly. These investments seem like they're positioning Uber not just as a middleman for transport, but maybe as a future leader in urban logistics infrastructure itself.
That's the potential, yeah. They're making some bold moves that could totally reshape their costs. Remember that announcement in October 2025? Plans for an autonomous taxi fleet in San Francisco, launching late 2026.
Right, and this isn't just talk, is it? They mentioned partners, using Lucid Gravity SUVs, leaning hard on NVIDIA's AI for the self-driving part.
Precisely. And what's fascinating is how economy just flips the profit equation. Right now, the driver commission is Uber's biggest variable cost, obviously.
Sure.
If even, say, 10% of their rides become autonomous, that cost disappears for those trips. The revenue from those rides basically drops straight down to operating income. It fundamentally changes the whole margin profile for mobility.
And you could argue it's even more impactful for delivery, right? Autonomy could potentially solve that whole last mile cost problem, which often makes deliveries barely profitable or even loss-making today.
Absolutely. And they're not just betting on the U.S. either. They're smartly integrating with some big Chinese robotaxi players like
Mhm.
Pony AI and WeRide. They just authorized more investments there recently.
So diversifying the tech stack and the regulatory environments.
Exactly. Hedging their bets, it's smart capital allocation for such a, uncertain future technology.
Okay, so those are the huge multi-year strategic plays.
Yeah.
That justifies maybe looking at a 12, 24-month horizon for the investment, letting the market start pricing in that massive optionality. But what about shorter term, like the next 3 months? Any catalyst that can move the needle?
Yeah, definitely. The biggest near-term thing to watch is the Q4 2025 earnings preview. That usually comes out in early February 2026.
Okay.
And given how strong mobility usually is during the holidays, travel, shopping, all that, if they beat their already pretty strong growth bookings guidance, what was it, $52.25 to $53.75 billion, a beat there could really spark some upside momentum.
And there are always those institutional factors too, right? Things
Yeah.
outside of company news, like that major ETF quarterly rebalancing on November 15th.
Good point. Uber's gotten bigger, more profitable, so its weight in those big tech and growth EPS has gone up. When those huge index funds rebalance, you often see a lot of short-term volatility, sometimes significant buying pressure.
Plus, you always have the rumor mill churning.
Always. There are those recurring whispers about them potentially buying a big European car-sharing platform that would juice their international growth, especially in micromobility and rentals where margins can be better in dense cities.
I also saw some chatter that the delivery segment, which, has lagged a bit on profits, might actually hit profitability ahead of schedule, maybe even before year end.
Ooh, that would be big. If either that M&A rumor or early delivery profitability turns out to be true, that's serious upside that probably isn't baked into the price right now.
So, okay, fundamentals look strong. Long-term catalysts are definitely there. Tactical drivers are lined up. What does this all mean for the stock price itself? Sentiment seems really positive.
Overwhelmingly positive, yeah. So let's try and translate these operational wins into what it could mean for the shares.
Well, the technical picture looks pretty bullish too. Analyst consensus is a firm strong buy. Out of 31 analysts covering it, you've got 27 buys, only 4 holds, and 0 sells.
Zero sells.
Yeah,
That's pretty rare for a company this big. It signals incredibly high conviction on Wall Street, doesn't it?
yeah,
Suggests the profitability shift really changed how institutions see its stability.
absolutely. And the average 12-month price target is pretty aggressive, around $110.61. That's about 11% upside from where it's trading now, near $99.82.
Okay.
Technically, it's bumping right up against its 52-week high of about $102. If it can punch through that resistance, maybe helped by strong Q4 guidance, the technical chart suggests a target somewhere between $115 and $120.
And for traders, we should mention the volatility. It has a high beta,
Mhm.
1.48, which just means it tends to move more than the overall market. So when there's good news and the market goes up, Uber often goes up faster. That amplification is key for tactical plays around earnings.
But, okay, we have to talk risks. You can't build a case on this kind of growth and valuation without looking hard at what could go wrong. What are the main clouds still hanging over them?
Yeah, definitely need to balance the picture. Even with that great Q3, they're not immune to risks. And what's interesting is the main company-specific risks are really structural and labor-related. Driver supply, driver retention. That's a constant pressure globally. Competitors are all fighting for the same drivers.
And the big regulatory hammer is still that driver classification issue, right?
Precisely. The legal battles over whether drivers are employees or independent contractors, especially places like the UK and the EU, they're ongoing. If governments start forcing Uber to classify drivers as employees everywhere,
The costs would explode.
exactly, payroll taxes, benefits, minimum wage, it could just completely erode those margins they've worked so hard to build. That risk is serious, and you have to watch it closely. A bad outcome there could drastically change the whole investment case.
And there's also that sensitivity to guidance we saw even after the great Q3. The stock dipped initially just because the Q4 EBITDA guidance wasn't quite at the very top end of analyst hopes.
Yeah, that's a huge red flag. It tells you the market is basically pricing in perfection already.
Right.
So if they miss guidance, even slightly, or if there's some macro slowdown hitting bookings unexpectedly, the downside could be really sharp. That high conviction cuts both ways. It means the stock is priced for flawless execution.
So if we bring it all back to the big picture, the valuation, it looks reasonable, maybe, but only if you believe that growth story continues. A trailing PE around 17, revenue multiple of 4.4. It's not cheap, but for a market leader growing 15–20% and scaling profits this fast, maybe it's a fair price for that kind of leadership now that they're solidly profitable.
I'd agree. They've kind of moved past the valuation risks of those early cash-burning growth stocks. The fact they actually generated significant net income last year gives them a real financial cushion.
So putting it all together, Uber Technologies looks like a pretty compelling opportunity right now. You've got the near-term momentum from strong earnings, which gives confidence. But the real juice, the big upside, seems to be in that long-term optionality with AI and autonomous vehicles.
Yeah, we rate the overall bullish thesis pretty highly, maybe an 8.5 out of 10. But investors need patience here. That 12 to 24-month time frame feels critical. That's when we might see those first autonomous pilots shift from just testing to maybe limited commercial use.
And that's when the market gets the first real data on the true margin potential, right?
Exactly. That's when you can see the stock price really start to reflect that fundamental shift from a human-driven logistics firm to potentially an AI-driven platform. That transition is the core long-term story to watch.